Hi guys, I'm here with Brian Dewald with Fairway Mortgage and the Dewald and Associates team. And as you know, he's a great partner of mine. If you've seen any of my videos, you've seen him several times before. So I want to introduce Brian. We've obviously had a crazy couple of weeks, to say the least, in the mortgage world. And so I wanted to just provide some great information straight from the source, and you are that source. So why don't you tell us what's going on?
Appreciate it, buddy. Yeah, so really excited to be sharing this with you and going through some information. So, this year has been pretty unprecedented just in terms of, if we look back at the previous 2 years, right, we saw all-time lows like forever, twos even in the, percentage ranges and stuff. So, coming out of the end of last year, we saw a pretty sharp increase right at the beginning of the year. And really what sort of kicked things off for this sort of cycle of increased rates has to do with the Fed. And not necessarily when the Fed is moving interest rates per se, but a lot to do with their actual actions. So, during all of COVID, the Federal Reserve was purchasing mortgage-backed securities to the tune of billions of dollars every month, upwards of $80 billion in a month they were spending to purchase mortgage-backed securities to keep rates really, really low. At some point, they had to start tapering that back a little bit, and their intent was to kind of do like a waterfall effect, right? Like, we're going to taper off a little bit here, a little more, and a little more. Well, come January, early part of January, they literally did like a light switch. They just shut it off. So we saw a pretty good spike right at the beginning of the year. And then ever since then, just all of their other comments and actions, not necessarily directly tied to the mortgage-backed security market, but just everything else that's going on financially. Think stocks and bonds and inflation and shortages and you name it. All of that has an impact in the mortgage industry, and we've seen a lot of that this year.
Well, and look, when you hit rock bottom, there's only one place to go, right? And
right.
The Fed's, we've been hearing about these announced increases in rates for the last year and a half. And last year they didn't do a whole lot of that, but this year it's finally caught up and they said, hey, it's time. And so we shouldn't be surprised that they're here. I think it's just the rapid fire, like the way that things have increased, because like you said, just a month and a half ago, you had people people locked in at rates in the fours. Is that right? Yeah.
That's just
and you mentioned, at the beginning of the year they were in the high twos. So really, that's sort of the rock bottom, and now we've just gone up from there. So, right. Well, obviously, Brian, there's always going to be people that need to buy homes, and so
sure.
There's still reason to be optimistic. We just have to, we can't compare ourselves to last month. We have to compare ourselves more historically and understand that there's, money is still relatively cheap to borrow, just not compared to the last couple of months. If you're in that position, what do things look like right now?
I think things still look great. You know what I mean? If we're lucky enough to get a house under contract, we're not seeing anything near the teens or anything remotely close to that. I am thinking we're going to start kind of leveling off here a little bit. The market needs to do that, from a mortgage rate standpoint. Yeah. The secondary market, which is everything that happens after we close loans, is a little bit of a mess at the moment. So the faster things can sort of just level off instead of these crazy up and down yo-yo type movement, the better off everything's going to be. So
yeah, and I know you've mentioned to me a couple of times that you thought the dust would settle a little bit on that and that things will kind of mellow out a little bit. It doesn't mean that there might not still be increases, right? But it'll just be less volatile and a little bit more predictable. Is that right?
That's what we're hoping. Yeah. I mean, that's what the experts are saying in our world. That's certainly, our fingers are crossed there. Anytime there's really, really quick movement in mortgage rates, it's obviously hard on the consumers, and it's I don't want to say equally as tough on our industry, but things get hard in our industry when there gets to be this much movement at such a fast pace, whether it's rates are going up or down. Right. Makes the secondary market really difficult.
Well, and back in 2018, rates hit 5%. And, I think that wasn't all that shocking to people. I mean, clearly not everyone wanted to pay that rate, but that didn't happen necessarily just like a huge jump overnight. We kind of crept up there. Right. And that feels better, and it just, people get adjusted to it. When it goes up as fast as it has, it's been tough. But listen, that's all the time that we wanted to spend on this. We've got other big topics to cover next week. And so we'll go over that, and we'll talk about some of those increases that are coming up. But Brian is a phenomenal resource to just be able to bounce information off of really get, like I said at the beginning, get information from him, from the source directly, so that you know what's going on. You're not necessarily listening to the crazy hyped up news stories that we hear about things being out of control. There's a true story. There's people that, you know, if you need a mortgage, there's a way to go about it, and there's a way to approach, you know, your financial picture. And Brian's obviously the guy to call. So appreciate it, Brian.
Appreciate you.
We'll do this again next week, and we'll kind of give a quick update on how things are going. And these things obviously adjust every week. So
look forward to it.
Thanks again, Brian.
Thanks, Matt.
Yeah.